Good afternoon. My name is Don Vivrette, and I want to welcome you to the It's Your Estate series. Let me advance us a slide here, and we will, there. Okay, today's module is going to be charitable giving, and it's going to be done jointly. So I will have a partner as we go through this. David Moore from Chapman University will be presenting with me. So we are co-presenters as we go through and do this module. We'll get to that one in just a minute, but first let me go through a few housekeeping pieces here. They repeat it. Even yesterday, there was the question of where are the materials? Where do I get to things? So as I've said before, there's roughly 300 of you who are registered for It's Your Estate, also for money. There's an overlap of many of you. In the reminder that you get, there's a note at the bottom that says, here's where you go to the website to get your materials. And honestly, they're there. And that's where the materials are. That's also where the videos are. And I want to point out, incidentally, that there was a mix-up yesterday. In yesterday's session, if you happen to be there, we had Chalk was the presenter. There was some handout material that didn't get put in time. It is there now. So if you go back to yesterday's week 5 for money, there's a handout there from Chalk if you would like to take a look at that one. Again, question and answers is done by the you move your mouse or tap on the screen or something, and you'll have a little Q&A that comes up. And today, Pete's going to be answering Q&A for us as we go through. Again, if you go to materials, this is where it is. You can pick between money or estate, and you scroll down to what week you want. In this example, it happens to be pointing at the video for the session that was done before, just to show you that video will be on the top. That's the way we've set them up. And then any other handout material is there also. These are the sponsors. That question had come up along the way of who are the sponsors for all of these. And so the sponsors are as you see them. If you click on them, you go to their website and you can take a look at what all's going on with them. There was a question that came up yesterday, and because it also, I think, relates to estates, I wanted to raise it here. There's a coalition for compassionate care in California. You can go to their website and they have various handout materials that you can download. We are not going to be able to put them on the website. We had mentioned that yesterday. They actually are something you have to pay for. So we will not, in fact, be able to do that. But just to let you know, here is the information, coalition@ccc.org. You can go in, you can be a visitor and be able to look at some of these things and download the PDFs. There's also one on finding your way. And there was also one on a POLST, because there was a lot of questions yesterday on a POLST. And so there's a handout material that they have. You can download those and they're available to you. Today we are doing charitable giving. Next week at this time, we'll be doing retirement account planning. And that's how we move on through the series as to where we are. Typically, this is where we would be. We would physically be at these various locations around the county. We dearly hope that in the spring, we're able to physically be there again, because that's a lot nicer. So we wanted to thank them in terms of what's going on. These are the participating charities that we have. Chapman has been a sponsor for 10 years. I give them that shout out. And today we even get David Moore with us to be able to do that. So these are the participating charities. Normally, when we have the charities present, they would come and do a presentation. Because we're in a virtual world, we are not doing that now. Instead, what we're doing is we're going to show a video. So I am going to pause a bit for myself and hope that I can find this and this. And pardon me for talking to myself while I do this, and hit share and find my mouse. Find my mouse. I should buy a touch screen, because then I wouldn't have to keep looking for my mouse. Nope, didn't work. Oh, there it is. Got it.
Hi, I'm Hallie Jones, the Executive Director of Laguna Canyon Foundation. Laguna Canyon Foundation was founded in 1990 with one mission: to preserve open space. We've been incredibly successful at that mission. Today, Laguna Beach is surrounded by 22,000 acres of protected open space. About 10 years ago, we realized that our mission needed to expand beyond buying open space to actually restoring and protecting that open space once it was in public hands. Today, our outreach and education, habitat restoration, and trails programs do just that. Each year, we bring thousands of people out into the parks for free guided hikes covering things like native plants and geology. Our Title I schools programs bring about 4,000 kids each year out on free science-based field trips into our wilderness. And our habitat restoration and trails programs get native plants in the ground, remove invasive species, and maintain and repair our trails for all users. In order to do this work, we depend on people like you. Our 125 volunteers staff park entrances, patrol the backcountry, and help with trail work and habitat restoration projects. As a 501c3 nonprofit, we also depend on people like you for financial support. Our funding comes from a combination of foundation grants, government contracts, and donations. I'm so happy to be a part of these workshops because estate gifts or planned giving can absolutely change the future of an organization like Laguna Canyon Foundation. I encourage each of you to give some thought to a cause or an organization that means a lot to you personally and consider remembering that cause in your estate. Thanks so much for having me here today in these very strange times, and I hope you enjoy learning from Dawn and from Pete. Stay safe.
Wilderness is not a luxury, but a necessity of the human spirit. Rarely is nature a part of our daily lives. In this overdeveloped world, urban sprawl separates us from the wilderness and the beauty that refresh our souls. In 1989, thousands gathered to protest the development of Laguna's open spaces, and Laguna Canyon Foundation was born. Today, Laguna Canyon Foundation works to preserve and protect the 22,000-acre open space that surrounds Laguna Beach and enriches our lives. Laguna Beach is unique because of our protected marine sanctuaries, our enduring art community, and our neighboring wilderness, known simply to most as Laguna Canyon. From Orange County's original inhabitants to all of us living here today, this land has sustained us physically, mentally, and spiritually. This land is also home to hundreds of species of native plants and animals. Tragically, native residents like the mountain lion are all but disappearing from this area, which was once their natural habitat. We all benefit from our local wilderness, with its rich biodiversity and 70 miles of trails. As neighbors to this open space, we have a responsibility to protect the land that we love. Through additional land acquisition, trail maintenance, stewardship to mitigate invasive species and nurture native habitats, educational programs that develop the next generation's appreciation for the land, and through public outreach that includes free guided hikes and activities throughout the year. Laguna Canyon Foundation, its volunteers, and its supporters are proud to preserve and protect our open space for generations to come.
Okay, Pete, there's Pete. Hang on just a second. Let me stop sharing. There you go. Okay, before Pete starts, I'm going to disappear for a minute because I have to queue up the next presentation. So I will be right back. I'm just, so you don't have to stare at me staring at my screen. I'm going to figure out where my mouse went again and make that happen. You got it, Pete.
Okay, thank you, Don. And this is the first time I saw that promotional video from the Laguna Canyon Foundation, and I've been on the Laguna Canyon Foundation board for approximately 15 plus years, and started with Mary Fagras and Michael Pinto, and when there was the great idea to keep it open space. What I like about it is that, you can think globally about the environment and supporting it, and donate locally. It's something that you could see on a daily basis. If you've never been to the Wilderness Park, I would invite you to there. And if you can't do the trails and need a ride through the backcountry, please let Laguna Canyon Foundation know. It is, you can't believe once you're out there how glorious it is. So if you're an environmentalist or that's what you believe in, Laguna Canyon Foundation is a local nonprofit that's outstanding. There are over 5,000 nonprofits in Orange County. So pick something that you're passionate about. We're just kind of giving you ideas. And just in Orange, here in Laguna Beach alone, there are over 150 not-for-profits. Let the money do some good. Don, are you going to pull up your...
We're good to go. David, do you want to come in? There you go.
Hi.
Pete is going to be the moderator, so he gets to disappear today, and we will hear from him along the way. So I am going to, David, this is David Moore. He's from Chapman University. We will do an introduction with him in a moment. I'm going to bring up a PowerPoint that we're through this time. There you go. Okay, so David and I are going to do this together. We'll let him introduce himself in just a minute. I am, as you have seen on the slides before, helping with these and working through all of these. Basically, why me and why, hang on, let me move something. I was wondering whether this was going to happen, so let me move this guy out of the way. There, okay, now that should go away. Yep, okay. I'm a CPA, which means I'm fascinated, I guess, by numbers and what all to do with them and whatnot. Over the years, my wife and I have set up a living trust, a pour over will, all the documents that we always talk about. A few years ago, our daughters asked if they could take over the company. So we gifted our company to them and set up another trust. I'm going to come back to that gifting in a little bit because it's important to see how that works, but that set up another trust for them and they manage that. We had an office building and we're about to sell it and realized we would pay, luckily and horribly, a lot in taxes. So considered doing and did do a charitable remainder trust, a CRUT, and that's another trust by itself. And I will talk about those as we go through the day. As a part of that, we also then set up a connected donor advised fund so that half of the money left over goes into that and our daughters will manage that money. Because of all the numbers and curious of what's going on, I became real interested in it and started helping people and looking at what they could do and what their options were. So that's what has caused all of this. And we certainly are in unprecedented times in terms of what's going on. Ask First form. I decided I'd change my Ask First form because it's hard to read the other ones. So I split mine in half. I'm actually going to do my own, unless Pete dives on me here. I have a master's degree, bachelor's of business administration in international business. I've been a CPA for 30 years. After getting my degree, I went to work for a large accounting firm, got my CPA, and I have kept it active for all of these years, mainly because I'm an expert witness at trial for a client. And so they prefer having me have an active license. So that isn't a problem. So there's my license number. If you want to look me up, it will be very boring because I really don't do a whole lot with it from an accounting standpoint. I'm the philanthropic advisor to finance and estate literacy. Pete had asked that I help with that. And I help people figure out what they want to do and what their options are. Crescendo software is the software that you will see the examples throughout this day in terms of what we're looking at. They have a certification program that means that you've gone through and done 50 different modules of work and come up with the ability to run all of the different pieces of their software. I do not practice law. I would want to do that. I prefer being on the other side as an expert witness. So I do not practice law in any way. My business relationship is strictly with the individual. What I believe is if someone comes and says, gee, would you help me do this? My whole thing is, my argument is I'm charity agnostic. I don't care who you give to. I care that you do what you want. That's what's important, not what I want is important. It is strictly what you want. If I were going to charge, I guess I'd charge $200 an hour. I haven't ever charged anybody. I've spent a lot of time with people and helped them in any way that I can. And to me, that's my goal. I am retired. I don't need to be doing that. And therefore, I'm doing this because I want to do that. And so that's what I go through and do. I don't sell immunity and annuities, insurance, mutual funds, any of those kinds of things. And therefore, false because everything I do is for the individual. And I've signed it under perjury, whatever the whole thing is. As a note, I'm going to go forward and we're going to get David's. David does not have an Ask First form because David works for the university. And so we know that he works for the university, and therefore it made no sense for him to have an Ask First form to go through and do. So David, why don't you introduce yourself?
All right, excellent, excellent. Thanks so very much, Don and Pete, both. Let's see, so I'm David Moore. I'm the Assistant Vice President for Legacy Planning at Chapman University. I've spent 27 years of my life working in higher education and philanthropy, so working as a philanthropic advisor. So I've worked with lots of people over a good long period of time, a lot more years than I think I feel like should be added up, but it really does. Those years adds up. So I broke them down for you so you could see where all I've been through the years. I specialize working at Chapman. I work with our estates and trusts, so donors that want to do something through their will or their living trust or other tax benefit plan. Those are the types of things that I work with. I've done tons and tons of classes and seminars and workshops. Most significantly, I went through and did the classes and the exams for the American Institute for Philanthropic Studies, which is based out of Orange County, actually. So we're very fortunate to have that located in the region. I believe it's actually Los Angeles County, if I think about it now. Chapman University has been a sponsor of this series since 2010. Don kindly acknowledged that, and we're just celebrating that this year. I attended these series back when I first started in this position back in 2008, and I just thought to myself, we should be a sponsor of these, and that's how we ended up just within a couple of years being a sponsor, and have enjoyed being a part. And the why now part is really, as I've got noted here, it's your legacy can be really meaningful if you plan thoughtfully. If you think about it and you make some provisions, you can really do something impactful. And a great way to do it is through your estate planning. So there we go.
And just as a note for you, and pardon me if I look over here, but that's where I can see my picture. So David gives us these very nice pens when we're in person and gives you a flashlight so that you can read the menu when you go into a restaurant. So for all of you who've done this in person, if for no other reason, let's get over this virus so we can meet in person so that David can give us pens again, because they're wonderful pens. There we go, David.
Great. Thanks for the plug on the pens.
You bet. It's well worth it because they're very important. Okay, so what issues are we trying to resolve? The issues we're trying to resolve are basically things like you've been living in this house for a heck of a long time. You want to sell it and move into something else, but you're going to pay a horrible capital gains tax. What can you do? And are there things that you can do if you wanted to give money away, or on the other hand, be able to save it? And I'll talk about that later on in terms of the charitable remainder. But how do I get out of this, and how do I move on and do something about it? The other thing that we know is that there are, we'll be nice and call them creative kids who are spending their inheritance all at once, especially if it's an IRA account or something like that. And how are we going to help them, control them, and yet be fair to all of the other kids that you have? Or what issues do you want to look at in terms of managing that? The other thing is, how do I give to charity and get something back? I mean, that sounds on one hand a little bit, crass, I guess. But the real question becomes, if you give during your lifetime, you get a income tax deduction, not just an estate tax. Since the estate tax is $11.58 million for an individual, most of us aren't going to be affected by the estate tax. But income tax is a critical issue to us, and we're paying a lot in taxes. And so therefore, is there a way that I could give something away and yet get a benefit out of it? Assure the income that you would like for the rest of your life, and perhaps even for your kids. And basically, do I want to give to charity now, or do I want to give to charity after I die? And many people will say, well, yeah, but I got to control the money, because that way I need to know what's going to happen, so I have money. And that's a very important characteristic, but that's part of what we'll talk about as we go through this.
All right. So why do we care about giving? So this is a really important Right? And, we've got it spelled out for you across the board here, right? It makes you feel good that you've done something for others. You can support the causes that are important to you and the charities that have been a part of your life or that you've supported throughout your lifetime. Those are good things to support. And Pete will always make the case that you live longer when you're charitable. And that's just, there's a lot of factors that come into that, but I really think that is true. People live longer when they're generous of heart and they want to do something for others. It counts well for life. Also, and this is something that a lot of people don't know, is that you can use charitable giving as a way to generate income back to yourself. And we're going to talk about that during this program. It's an important thing to kind of wrap your head around, because we usually just think of it in terms of giving money away. But there's some interesting opportunities that we have with charitable giving that we're going to talk about today that lets you understand how you can give money away and get money back in the process. And I'm not just talking about the charitable deduction as well. So again, we'll touch on those things. And then giving can result in tax savings. So that's your charitable deduction, and it can you can get charitable deductions with your current giving during your lifetime. If you have an estate gift scenario, you can get a charitable deduction with your estate can get a big exemption for the charitable gifts that are made. But under those current tax gifts, right, gifts that are made during your lifetime, there's some interesting things, and Don's actually going to touch on this right away, but there's a deduction against your adjusted gross income. Usually it's 60%. Don's going to tell you something very special for cash donations that are in the year of 2020. So we'll touch on that. And then there's also a 30% deduction for appreciated assets. So Don?
So I wanted to go through just sort of where's the economy now, during COVID, and after. Part of this comes down to the Secure Act, which actually was 2019, changed a couple of important things for you in terms of your planning and your retirement. The required minimum distribution, frequently referred to as an RMD, used to be at 70 and a half, you had to start taking it. They changed that to 72, probably because it was confusing to figure out what 70 and a half really was. The important part that was changed during the CARES Act in this year was that you do not need to take your RMD during 2020. And if you do not take it, it doesn't mean you have to double up next year or the year after and start it again. You will have to in 21, presumably, have to begin paying your RMD, but it is not, you have to make up for 2020. So that is not a requirement for this year. The qualified charitable distribution, which is very important for you to know about, is if you're over 70 and a half. They did not change the age for that. We'll talk a bit in many pieces about the qualified charitable distribution. One of the things that really changed in terms of inheritance and who gets what, they stopped the stretch IRA. It used to be that your child could inherit your IRA, and they would take their distribution over their lifetimes if they wanted. They didn't have to, they could take it immediately, but they could stretch it out over their entire lifetime. Now that's limited to 10 years. Spouse doesn't count. Certain other limitations, it doesn't count. It's still stretched. But for your kids, it's going to be max of 10 years. There, however, are ways around that. And so we'll talk about that and things that you could do to help control where some of the money is. David alluded a moment ago to the differences in the CARES Act. Normally you get 60% off. You can use 60% of a cash distribution, or if you give to charity X amount of cash, you can use up to 60% of your adjusted gross income. And that's basically the bottom of the first page of your tax return before you take your standard deductions or other things. That's the adjusted gross income. This year, they made it 100%. So if you don't like what you're going to be paying in taxes, you look at what that AGI is, and you can give to charity up to 100% of that amount if you have the cash, then wipe it all out, not just 60%. If you use appreciated assets, it's still 30%. Gift tax allowance. Gift tax and inheritance are combined. over your lifetime. You can give $15,000 to anybody you want each year, and you don't have to report it to anybody. That is not a gift in terms of what the IRS says. So for instance, my wife and I have 2 children. They're each married. They each have 2 children. So that's 8 people. I could give each of them $15,000 if I had the money, and that none of that has to be reported, and yet that's $120,000 out of my estate. So if I think I'm at risk of exceeding the 11.58 million, which I don't think I am, I could then have used that and have to report none of it to anybody. And my wife can do exactly the same thing. And it doesn't have to be children. It could be anybody you want. You could give the money to Pete if you want. Anybody you would like, you can give the $15,000 to and not have to report it to anybody. The inheritance tax exemption is currently 11.58 million for an individual or 23.16 for a couple. Anything over that is taxed at 40%. So if your estate is 25 million, then roughly 2 million of it is going to get taxed at 40%. The deductions against that are give money to charity, do something else. That will expire in 2025. However, it can be changed at any time by Congress and the president. So there, as we come into an election, there's certain indications, although there's no certainty on either side, what exactly the new administration would do and whether or not they're going to control Congress to be able to do it. I said I'd come back to the fact that we gifted our company to our children. We chose to give it to them as a gift, and I had to do a gift tax return. And let's say the company was $2 million that I gave them. We had to report that, pay no tax on it. But in my case, my exemption today is 9.58 million because I've already used 2 of it. So that's how you do it. Didn't have to pay any tax, didn't have to die to get it, but that's how you can use that. If you wish to give more than $15,000 away, you simply report it and it's there, and that's what you do with it. So basically that's where we are with the economy in terms of what's going on. And let me go ahead one more. There you go.
All right, thanks so very much. So this is something that's important to understand is retirement accounts. Retirement accounts, the funds that are in those, and I'm talking about like an individual retirement account, your IRA, if you worked in commercial business, your 401k, or if you worked in the nonprofit world, the 403b, those are all items that all accounts that when you were earning those funds and they were being placed into those the funds were growing in that account without ever having experienced taxation, right? So they've been growing all this time, getting larger and larger and larger without any taxation. So in order for those funds to come out, in theory, they're going to have to pay tax, right? So we're going to talk to, and that's called income in respect of decedent, right? The income in respect of decedent is that any funds that are coming out on top of the, that need to be taxed are going to be are those IRD assets, right? So there are some things that we can do there that allow you to work around having to necessarily pay the taxes on that. Now, so we know that there's income in respect of decedent, right? So there's also, if you have those accounts, you know that you have a required minimum distribution from your IRA account in particular is one we're going to focus on. But with any of those accounts, you're required once you're age 72 or older to start receiving those assets, right? They're taking the required minimum distribution. And that's all based on the value of those accounts at the end of the last year, divided by a factor based on your age. You can see that's all written up here on the screen for you. And it adjusts. And if you look over here, in those little square boxes, we've got some examples built out for you that shows, so if you were at age 70, there's a factor of 29.1 that you would use against whatever the balance of that account was at the end of the last year. And then that would help you determine what your distribution would be. And we've got an example built over here as well. So if we were using a if we wanted to do something called a qualified charitable
David, let me interrupt you for just a moment. I want to do two things with you. One, because when I put in this table originally, it doesn't change every 5 years. It changes every year. I just wanted to show them along the way. So don't think if you're 72, well, which number do I use? You'd have to look up that number. The other thing is when we say that it comes in as taxable income, this comes in as ordinary income to you. So it's going to affect your tax rate. It's going to affect your Medicare payment. It's going to affect all of those things because this comes in as plain, simple, ordinary income. No capital gains, no nothing else. It went in as ordinary income. It comes out as ordinary income. So that's important to remember, which is why David's going to talk about QCD.
Yeah, absolutely. Thank you. So if you have from your IRA account, right? So you have a qualified charitable distribution. Well, after age 70 and a half, you can at age 70 and a half, you can choose to, rather than taking that qualified charitable distribution, you can take a portion of, instead of taking that required minimum distribution, you can choose to take part of that required minimum distribution or all of it up to $100,000 and can transfer that to a charity. You actually tell your plan administrator, your custodian of your account, that you want to send a check directly to the charity out of your qualified out of your IRA account, and that's called a charitable IRA rollover. And it's a magnificent thing. If you do not itemize your taxes, this is definitely the way that you should be making your charitable gifts. It is the most tax smart option thing that you can do. It's really an excellent option.
And as a note, incidentally, David, one of the things that, because my wife is a little bit older than me, 6 months, she actually had to take her required minimum distribution in 2019. So what we did was she got a call from the administrator of the account, and she said, I want to give these charities this much money, and I want you to write the check to the charity. But different from what David said, we had them mailed to us. We got them, made a photocopy of them so we had a record of it, and we mailed it to the charity. Because at the end of the year, you're going to get a 1099-R, I believe, from the custodian that said, in this case, the example here would be $24,753 you have as income. But I'm going to tell my accountant, yes, but this much of it we gave to charity, and dollar for dollar, that's reduced off of our income. Do you want your example?
Well, so let me, right before I go to that example, Let me say, absolutely, you can do that. You can have them mail the check to you, but it's critical that that check be made payable to the charity. That is the most important part of that. So they can do the distribution directly to the charity, which is what most people do, or you can choose to have it sent to you, but made payable to the charity. So that's an important thing. We're going to go into an example here. If you look at this on the example that's on the screen that we're on right now, before we switch screens,
Sorry.
All right. So I just want to take here this example, right? So someone had that balance of $500,000 in their account, and at the end of the year, and they were age 80. So if we look over to age 80, right, we can see that it's a factor of 20.2 is the factor that's calculated on. And once that's done, it's determined that there's going to be a required minimum distribution of $24,753. Now, I wanted to point that out because we're going to make use of that on the next page. All right, so that $24,753 was that amount that had to be taken out. But, and somebody can choose, you can choose and say, you know what, I would like to make a gift, and we're going to use an example here of $15,000 that I want to go directly to a charity that's important to me, right? So they'll call the custodian, they'll have them make the check payable to that charity, and they'll say, I want 15,000 of it to go to the charity, and I want the other, the rest of that change, the other $9,753 to come to me, and so you can do that. So you indicate the custodian then makes the gift to the charity, or at least makes the check payable to the charity, and either sends it to you or sends it to the charity directly. The great thing here is that now that $15,000 never got realized as income for you. That means that you did not have to ever file, or you don't have to add that to your taxes. You don't have to count it as anything that you'll ever be taxed upon. So it really replaces, and again, goes back to that point. If you no longer itemize your taxes, and most people don't need to at this point with our current tax system, if you don't itemize your taxes, this is the way you should be making charitable gifts. Make them out of your IRA, and you can have as many checks written as you want for as many amounts as you want, as long as the total overall doesn't exceed $100,000. Anything over $100,000, you're going to have to accept as income in addition to then, and then you'd have to claim a charitable deduction beyond that point if you wanted to do that.
And just as a note, incidentally, we use 15,000 here, and you're going, no, I need the money. Okay, but do you give money to your church? Do you give a small amount here or there, whatever it happens to be? You can have that check come out of your IRA account anytime during the year, and it all adds up because of this $15,000. If you were just only in a 20% tax rate, you would have had to have paid $3,000 in taxes to get that $15,000 to give away. So you just saved that money, and incidentally, your taxes are down, and incidentally, your Medicare charge is probably also down if you were breaking through the various levels, because I know a lot of people have complained about that one.
All right, excellent point. All right, so we're going to move on and talk about IRA accounts. When you leave an IRA account to your heirs, there are a lot of real issues that come into play. So first off, the Secure Act that Don talked about a little bit ago, the Secure Act requires that heirs, meaning other than spouses, right? But other than your spouse, they have to take that out within a 10-year period of time. We used to have this great thing called the stretch IRA. Now, the Secure Act limited to the stretch to only be a maximum of 10 years, that all of the money that's in there. So if you have an account with $1 million in it, money's got to come out of that every year, and it's got to all be gone within 10 years. And so, that'd be $100,000 a year that you're adding to the income of your kid already at whatever age they are. When I say kid, I mean your adult child. And so there's a couple things that come into play, right? They're going to get taxed on that $100,000 on top of the other income that they're receiving, and so so those are all big factors that come in. And then it comes into play, what's going to happen when the kids get the money, right? So often what happens is that the kids get the money, and it's like winning the lottery, right? They spend quickly, and they buy the new car, they take the vacation, and all that money you worked for all those years goes away just so quick. So you can have some options here that come into play that we want to really talk about, that can be helpful to you. And just remember that whatever happens in the current scenario, they're going to take out that money, so they're going to be taxed on it. And then, however, any funds that are in those accounts that can go to charity don't get taxed. So you could either take the assets that are in your IRA account, and you could name a charity as a beneficiary of your IRA account, whether it be the full amount or for a percentage, or you can do kind of a very similar thing, but have it benefit your heirs as well. And that's what we're talking about here on this slide. And that is you can set up what's called a testamentary charitable remainder trust. Okay, so it's a testamentary trust, and in this case, we're doing a testamentary charitable remainder trust. And you have it funded with your IRA. And then upon your death, so after you pass away, the funds are going to pass into the IRA, and then it's going to create a payouts that are limited to either a specified amount, that would be a charitable remainder annuity trust, or a percentage that's going to be a charitable remainder unitrust, and so that it varies a little bit each year. We'll get into those details. The thing is that instead of being a stretch over a maximum of 10 years, now it can be a stretch over their entire lifetime. And that's an amazing thing. And then not only that, after their lifetime, any money that's left in there can go to support the charitable organization that you set up. We're going to touch on that next. And Don, do you want to touch on this? You want to hit?
There you go. So one of the things, there are a couple of slides in here that I'm going to say the order matters. So the order in which you do things dramatically affects things. So here's an arbitrary example: $2.5 million estate, 1.5 million in an IRA, and $1 million in the house, just for simplicity's sake. The kids say, well, we want the house because it's $1.5 million. We want the IRA because it's the big money and we want to be able to have that. Yeah, but that comes in as ordinary income, which means they'll probably have to pay somewhere around $550-something thousand in federal, about $200,000 in California, which means they net less than 50%, $745,000. Now, David, if you gave it to Chapman, is thrilled because he got the $1 million house. Okay, on the other hand, if you did, remove the screen, if instead you give the charity the IRA, David's even happier because now he got $1.5 million instead of $1 million. The kids get the $1 million house. Currently, there's a step-up basis at the time of death. So the house now is valued at $1 million, has a basis of $1 million. They could sell the house and keep $1 million. The order matters. If they took the higher IRA, it's completely taxed and they get less than half.
This is where you can really tell that Don is a CPA, that he loves to get into right?
But this is why these things become really important to think about. And even looking at the questions we've had over the various weeks helped me figure out what to do with this. And my first thought always is we should have backed up about 3 steps and talked, because then it would be very different. And so we'll talk about a couple of things as we go along here. David talked about the testamentary trust. The testamentary, incidentally, means you died. So after your death, this is set up and this is what's going to happen. So in this case, I just said, let's take $500,000. We're going to put it into a testamentary uni trust, which we'll talk about a little bit later. So they get a chest. Let's say they're 45 years old. In this case, the 500,000 goes in. They're going to get 5%. But over time, because they're going to have, it's going to tell me the years, I forget the number of years. They're going to have a long lifetime to earn money against this. So they're going to pull out $1.4 million over their lifetime. So instead of 500,000, it's going to almost triple in size up to a 1.5. Now, the difference is they cannot take out the money faster than 5%. So if you're concerned about what your kids are going to do with the money, this is a way to slow it down, but allow them to still stretch, in quotes, because that doesn't exist anymore. And then at the end of it, as David just mentioned, the charity gets $750,000. The reason is because we said only take out 5%. It's going to earn more than 5, so it will actually grow. So this charitable remainder trust is actually going to get larger as you go along.
All right, beautiful. So we're going to talk now for a moment about bequests. Bequests are the most common way that somebody leaves a gift to charity after their lifetime. It's something like 85–90% of all planned gifts, legacy gifts, are done through a bequest, and it's probably even a larger percentage than that. So that's the largest form of charitable giving. I want you to keep in mind, though, that you can also have the option of doing, as we talked about a minute ago, setting up a revocable trust with a charitable remainder. As we talked about, you can do a charitable gift that's given through your will or your living trust. You can also do outright or deferred benefits. So you can choose if you're going to make that gift directly to the charity or to an individual, or if you're going to set up a trust that's going to give that money out over a period of time. If it's to charity, then those are doing something like a charitable remainder trust. You get the added benefits there, as well as having the impact and supporting somebody that's meaningful, your beneficiaries for you as well. The important thing is that the bequests, right? So the things that are paid directly out of your estate, they're coming out of your estate before everything else is paid. So it reduces the value of your estate. And I'm talking about a charitable bequest here. it reduces the value of your estate by bringing that value down. And if you did fall into that estate tax scenario, then these can be very helpful and can save significantly, because as we talked about earlier, your estate is taxed at 40% if it's above the value of the charitable deduction that's associated there. I'm sorry, of the estate tax, I should say. We always like to recommend giving a percentage of your estate as opposed to naming a specific dollar amount. It really works. It has a lot of value to it, because when you're saying dollar amounts to certain people or to certain organizations, again, those come out before everything else is done, right? Before you get down to the more remainder value of your estate. So when you're talking about percentages, you know, your estate grows and it shrinks and it adjusts. If you do it by percentages, you're consistent, right? So that it's always 10% is going to this charity, 20% is going to this child, 20% is going over to this child. And however you divide things up, if you use percentages, then the value just modifies, and it's whatever it's going to be at that period in time. So it's a good way to do that, to be consistent and fair, and not as the way that the whole thing works. And of course, with a charitable bequest, there's no tax deduction, no income tax deduction when you're living, because those are your assets. But after you pass away, you've then named them. If you name them as a charitable bequest, then they're going to then they're removed from the estate tax if you fell into an estate tax scenario. So I want to talk about beneficiary designation, and this is different than a bequest. And I actually think that this is again, just like I talked about your IRA during your lifetime. If you have that option of doing the IRA charitable rollover, how smart that is during your lifetime as a gift. The beneficiary designation is really important as an option for making your charitable gifts, because it's the most tax-wise option, right? Because those are the assets that we talked about a little earlier. Okay, so stock accounts, bank accounts, life insurance policies, all of those have a beneficiary form that are signed off, and you can say, you know, this money goes to this charity, or this percent of this money goes to this charity. On your pre-tax accounts, then that's your IRA, your 401k, saving bonds, commercial annuities, as we have listed here. Those are assets that if you name the charity as the beneficiary, those assets pass directly to the charity without any taxation on them at all. So it's a really powerful way to make that gift. And if you're someone that doesn't like to pay taxes, this is a great option for you for working your way around, and yet it's having an impact. And it's amazing that we live in a country that wants to support, wants you to be charitable in your giving, and wants to encourage you to support the organizations that are important to you. And it really empowers us all. And so I think that using, particularly with your IRA, your 401k, your savings bond, and commercial annuities, those IRD assets, those are fantastic ones to use as for charitable gifts. And remember that simple form that you do with your custodian of your account, that very simple form doesn't require an attorney, so there was no attorney involved, and it also overrides what your will or your living trust may say. So if your will or your living trust says that the funds in that account are to go to a particular individual or to a particular organization, what's on the document is actually what's going to be that's with the custodian is actually going to be what rules. So an important thing to keep in mind is that if you and your spouse have gotten divorced at some point, or a member of your family has passed away that was otherwise going to be a beneficiary, those assets are going to go and with whatever the form says that's on file with the custodian. So it's really important that you know who your beneficiary designations are on all of these accounts, and that's a critical thing to keep in mind.
Before I go forward, I want to loop back on something. Just it relates to this one. For those of you who've seen me do this live before, I also pick on my sister. My sister at this point happens to be widowed, and I've helped her with a whole lot of different things. But one of the things that was interesting to me was for her 15th wedding anniversary, her husband asked what she would like for her anniversary present. And she said, for you to remove your ex-wife from the title of the house. And he went, huh? And pardon me for university people, this is your basic PhD professor of botany who has no clue of what all's going on in the outside world. But so he does not realize that he forgot to change the title. Now, good news is the ex-wife had no problem with this. He has changed the title. But to this point, make sure you keep track of your beneficiary statements, because you may have either someone's passed away, divorced, or something else. And don't be in the 15 years later, incidentally, would you take your ex-wife off the title of the house? So I use that as a note along the way. Okay, there you go.
That is exactly right. All right. What we want to do for a moment is talk about a charitable gift annuity. And we're going to show you an example.
And these are not commercial annuities. In the money side, we hound on you, don't do annuities. This is completely different.
Yeah, so this is different than what we're talking about in the It's Your Money series, where they're talking about annuities and don't do them. A charitable gift annuity is different. There's a lot of reasons that it's different. I'm going to go through some of those here. Most nonprofits, you should know, most nonprofits actually don't offer charitable gift annuities. You want to make sure that you're working with a larger nonprofit that is able to offer charitable gift annuities. A lot of them don't offer, but the ones that do follow the same chart. Most of them, 80–90% of them, follow the exact same chart and the same rates that are all set by the American Council on Gift Annuities. This is one of those things, this is one of those gifts that gives you the ability that you make a charitable gift and you get an income back for it. And so that's what a charitable gift annuity is. I should have said that to start us out. The rate that you get paid out on the money that you gift can be single or on a dual life, but it's based upon the age that you are at the time that you set up the annuity, the charitable gift annuity. I want to make sure I clarify that. So the rates are locked in at the point that it's established, and it doesn't adjust later over time with any sort of changes or anything like that that come about. The great thing is that the charitable gift annuity pays out for your lifetime, not just for a set period of time, but no matter how long you live, it will continue to pay out to you every single year. So if you outlive your life expectancy by an extra 10 or 20 years, good for you. You know, you can start making a profit, honestly. And so that's really a powerful thing. They are an irrevocable agreement, but it's a very simple form. With a commercial annuity, commercial annuities, the forms are usually about 30 pages in length. They're very complicated. They take a whole lot of going through and reading. There's all sorts of penalties that are built in. With a charitable gift annuity, it is 2 pages, typically 2 pages is it. Very simple to understand. It doesn't even require an attorney at any point. It's a simple contract between you and the charitable organization that you're doing a gift with. And there's all sorts of rules in the state of California in particular. There's a lot of regulations that go around the charities that are able to offer charitable gift annuities. They are required. Yeah.
David, let me stop you for just a moment in terms of the irrevocability. One of the things I forgot to mention at the very beginning of this session is we talked about David not having to do a ask first form. One of the things that's important is if you walked into David and said, hi, I want to set up a charitable gift annuity with you and let's talk about it and everything else. David isn't a salesperson. He doesn't get a commission for selling this. In fact, he's not allowed to have any kind of commission or pay or whatever else for doing this. So we can say that it's irrevocable, and it's irrevocable when you sign it. So get the simple two-page form. Think about it all you want. David isn't going to harass you. He isn't going to, oh, come on, this is the deal of the day. Let's go. I'll give you an extra 0.1%. No, that isn't the way it works. And because all of this is so heavily regulated, and people who do these, David's correct. You want to do this with a larger charity. You may, however, want to do it for a community foundation. So it isn't just a Chapman who would do this. The Orange County Charitable Foundation will also handle these and then allocate that money out, as opposed to a Laguna Canyon Foundation, for instance, who we had earlier as a presenter. They don't do charitable gift annuities because it is so regulated and so controlled. And that's where you handle these either through a community foundation or directly to a larger charity. Sorry, go ahead.
Yeah, that's all right. So, and one of the reasons why you want to work with a larger charity is that this is a secure form of income to you. And the way it's set up, the way that it's set up with residual funds that are set aside to protect the annuity and so forth, all those things are very heavily regulated, but it's all the assets of that organization are secured against that annuity for you. So if something ever happened to that organization, you were at the very front of the line to get paid out to make sure that your annuity continues. And that's a powerful thing to understand, that these really are a very secure way of having an income stream for life. And importantly here, you can have a deferred start date. So you can say, let's say you received let's say you received a nice bonus for your employment, and you thought to yourself, well, gosh, I don't need this money right now. Why don't I think about setting it up with a charitable gift annuity, but I don't want to start receiving the income from that annuity right away. Why don't I set it up for not receiving the funds for a few years from now? And you can do that. And when you do that, these rates that we have that are up on the screen here, they actually adjust and change, and they go up for you based upon that. And there's a calculation to it, and anybody that offers charitable gift annuities can show you what the rate would be for a deferred charitable gift annuity. And you can even set it up as a testamentary annuity to pay out to your heirs and or other beneficiaries that you might want to have receive those funds as well. So those are all really helpful to understand. And as Don has made a note here on the slide about consider using a non-income producing stock to open a charitable gift annuity. So if you have something that's it's highly appreciated, you've got some value on it, but it's maybe not income producing anymore, perhaps that would be an outstanding asset to use to fund a charitable gift annuity in the first place.
I always pick on Berkshire Hathaway, which, for all of its growth, for all of its years, it pays out no dividends. And it's a lovely stock from the standpoint of growth. But if you need to live, you'd have to sell the stock. Well, this way you could give something like Berkshire Hathaway stock to it, and it's not then going to probably earn 5%. But it will, because it's paying you money. And that's what you may want. And that's why it's important to look at an non-income producing stock.
Yeah, so we're going to look at a specific example here, and let's say we've got that Berkshire Hathaway stock here, and it's currently valued at $500,000, but you only paid $60,000 for it. That's your cost that we have on here. So $60,000 was your cost. That's what you paid for it, but it's now $500,000 in value, and so you've had a gain of $440,000 on it, right? So if you decide, well, that's what I'm going to use to set up a charitable gift annuity, then you can take those funds and you can place it. You can place that $500,000 into. You can give those funds to the charity to set up that principal, and that's going to take that $500,000 into a charitable gift annuity for you. At the moment you do that, at the moment you gifted it, you've already saved yourself. And if you look down here under point number 1, the little red box down there, you've got an income tax deduction of $195,685 right there. That saves you $62,000, almost $63,000 right up front with that stock gift that you had that you're now using. And you could have done cash, but in this case, we're using an appreciated asset. So
just as a note, incidentally, you may not need $195,000 tax deduction this year. You can take it for this current year plus 5 additional years. So
Exactly.
It isn't, oh my God, I need this. And that's 30% against your adjusted gross income. So that's a very important number to have. You gave away something, but you got a really nice return from it.
Absolutely. Now, in this example that we have, that $500,000 is going in and funding an annuity. If we look up here in the top right corner, we see that the annuity is for 2 people, Martha and George. Martha is 75 years old and George is 80 years old. And so there is a calculation that's used that has determined back from that what we mentioned, the American Council on Charitable Gift Annuities, the American Council on Gift Annuities, that determines that your payout would be 5.3% because they're 80 years old and 75 years old. And so that's a 5.3% payout on that annuity. So that annuity is going to start paying out every single year. What we got, $26,500 for every year for the lifetime of those 2 individuals. That means if one of those individuals passes away, it's okay. The funds continue for that time period, for their entire lifetime. Now they get out of that, and in this case, because we got so much of a savings in the capital gain, in saving capital gain. Our tax-free amount is $2,469.57 out of that every payment amount. If we had used cash, it actually would have been a much higher tax-free amount that would be coming out for you. So you can factor in some of those things and talk with a philanthropic advisor about how these things work and get some examples to help you determine. But in this case in particular, it's estimated that over the lifetime of these individuals, these 2 individuals, that they're going to get a total back of that $500,000. They're going to get $495,000, almost $496,000 back to them. And because they didn't have to, because they saved all that tax funds up front, and in the payout that they're receiving, it's just like getting a 7.13 annuity, right? So it's as if they would have been earning, if they had these funds somewhere else, they'd have to be earning 7.13% back on the funds rather than just the 5.3. So that's that added benefit of the charitable deduction that they were receiving. After the lifetime of those 2 individuals, after the lifetime of the surviving spouse, then whatever remains in that account passes to charity. Now, we showed it here at $500,000. You know, the way that it's calculated from the American Council on Gift Annuities is that they really expect for about 50% of that original value is there. That's what's typical, is it's going to be about 50%. But so it might be $250,000, but $250,000 to that charitable organization is an amazing gift to be able to make. And so that's just powerful to be able to share and talk about. We're going to go into a second example here, and that's that deferred charitable gift annuity. So this is another way of doing that same thing. And so here's someone, if you look up on the top right corner, it says prepared for kid 55. So the 55 is referring to the age. And when Don was creating this slide, we're using Don's slides today because it got so complicated to try to figure out which one's mine to use and which one is his to use. So
and incidentally, all of these slides are out of Crescendo. And certainly David has used Crescendo for a long time, very well known by them. But all of these are Crescendo slides and examples which are able to be produced.
Yeah, so this is a software program that most nonprofits use. Crescendo, or just a handful of others. PG Calc is another organization that we'll use for software that tells us that they all give us back the same information, the same numbers. That's the important part. So I think when Don was preparing this one, he was thinking in terms of that this deferred gift annuity was being set up for someone who's age 55 and doesn't need those funds right away. And so they've actually decided, if we look at here, the first payment's not until January 8th of 2030. So about a 10-year, nine and a quarter years that it's deferred for the payout. And I have a feeling, Don, when you set this one up, you set it up on earlier this year.
I set it up probably on January 8th. Yes, it was a 10-year deferral when I did it. It's
10 years at the time, right? So in this case, right, here's one individual, he's 55 years old. That initial, amount of that $500,000, it gets and remember that we already talked about, that there was that bypass of the $440,000 gives them, in this case, a $159,000 charitable deduction, which saves them $55,718. And that sets up a deferred annuity that's not going to pay out until 10 years into the future. So when the kid turns 65 years old is what's happening there. And then when it does start paying out, it's going to pay out. We can see here that the annuity, where's my percentage that's paying out, Don?
It doesn't have it. It did this screen didn't show it, the percent. Oh, I'm sorry. Basically, well, it's 32,000, so it's going to be 6.4%.
Yeah. So all right. So you've got your annuity payout is $32,000 that's paying out from there, and you can see that 34,000 of that is tax-free income, and so that $500,000 turns out to be paying out a lifetime income to that individual, anticipated based on their lifetime to be $816,569. That is an amazing lifetime outcome of receiving funds back on that $500,000. Not to mention that after that lifetime, there is still an enormous gift to charity. And again, typically 50% of the original amount. But it can be higher, it can be lower. It all depends upon how markets performed and many other factors going into there. So yeah, it's a powerful way, and so you can set that up, and really it's if you don't look at these options and know what they are, that's why we talked about this. That's why we've titled this program, secrets your advisors never tell you about. And the reason your advisors never tell you about these things is because they don't get a commission on gifts that are made to charity. So these are strategies that you never hear about that are incredibly powerful to know about. So Don, that's good.
Okay. Charitable remainder trust or charitable lead trust. This is the big dog approach in terms of what's going on. Frequently, these are larger. In our case, we sold a building. We put a building into the trust and we sold it. And the order is very important. I'll get to that in a minute. It works best if there's a significant capital gain. We had paid a very small amount for the building, held it for 20 years. Since it was in Irvine Spectrum, it happened to have grown very nicely. And we would have had a miserable capital gains that we would have had to have paid. Oh, woe is me, we would have gotten the other money. But I looked at it and said, wait, I can do this and defer the capital gain into the future. You don't get rid of it, you defer it. Now, we chose to put all of our building in. You can put in a part of it. Some people do it where they put part of the money into part of the property into the trust, and that equals that you get the tax deduction for the amount of the capital gain, for instance, and then you can keep the rest of the money. I'm sort of, I guess, in the sense of a Warren Buffett of, I wanted to make sure I had compounding, so I wanted to have as much growth over here as I could. In the way of a charitable remainder trust, you either get cash now, and the charity gets the remainder. If it's charitable lead trust, the charity gets the money now, the beneficiary gets it later. That sounds a little weird, and I'm going to tell you, I haven't had to deal with one of these. I'm going to say they're relatively rare. David may have done a lot of them. I think they're more for higher appreciated items. And if you think, for instance, my example is Facebook or Amazon stock before it went public. If you put that in, it now goes public. When the end of the lead trust ends, they get it at the different value. They don't have to pay tax on that. So it's very important for things like that, but that's a little bit more sophisticated. So cash paid out for remainder trust is either a percentage of the value. So think in terms of your required minimum distribution. At the end of the year, you value it. And in our case, December 31, we value the trust. This is how much it's worth. And we take out a fixed percentage over the next year, in our case, 4 quarterly payments. That's the one way of looking at it. You can also set it up so that it's a fixed dollar amount. That's a crap. Mine's a crut, there's a crap. The difference between a charitable gift annuity and a charitable remainder amount, basically a CRAT, is that a CRAT can run out of money. If you say I'm going to get X amount per year, that can run out of money. Mine can't run out of money, but it can get really small if we live to be 120. So that's the way those are set up. You specify what charity you want to give to, charity or charities, and you do that anytime during your lifetime. If Jane passed away, I'm then doing it. Nothing changes when one of us passes. It's over both of our lifetimes. And we can change those charities the entire time. In our case, we also, as I had said before, set up that 50% of the money left over at the end goes into a donor advised fund that our children will manage. So it's sort of the legacy, if you will, in terms of giving them something that they can deal with and looking at and saying, this is where they want to get. Ironically, in our case, they think that was so interesting. They've been using the donor advised fund from a company standpoint. Oh, we had excess profits. Let's put it in there and figure out what to do with the money over the next year. Ours happens to be with Schwab. It's inexpensive to set up. It's inexpensive fees. You can do it with the community foundation. Whoever you want to do them with, that's fine. They're either for a fixed period of time or in our case for our lifetime. I will tell you, this requires a lawyer. This is not a 2-page form for David. This is a book. I could reach down here and show you how thick the dang thing is, but it is a full level agreement. And so anything that's left over at the end of this half of it goes to these charities and half of it goes into the donor advised. And it definitely is irrevocable. So this is not something that you can, ooh, gee, I changed my mind. No, that generally is not going to happen. Let me show you an example. So since we picked on this 500,000 and the 60,000, I'll just go ahead and use that one as an example. So using that same thing in this case, if you put in the 500,000, you get a $196,000 tax deduction, income tax deduction, which should save you roughly $62,000, depending on your tax rate. Again, you can use that for the current year plus 5 years going forward. You can't go backwards, but it's current plus 5 years. That's 30% off of adjusted gross income. So when we set this up a couple of years ago, each year, and then in the next future few years, we get a tax deduction of 30%, which is nice. We say, in this case, they'd say it's $62,000. It's very noticeable when you go through and do that. In this case, we would, over the 18 years, get out of it $609,000. Now, in this example, this isn't like a charitable gift annuity where you have a specific rate at your age. This is where you go into the software, your advisor goes into it, I can do it, David can do it. Incidentally, to let you know, truth in lending here, David and his associate ran our charitable remainder trust simulation before I got the software for Crescendo. It's what made me go over and get that, because it was so interesting to me what David had been able to do. So whether David does it, I do it, whoever does it, they could go in and literally it will say, at your age, these characteristics, if you want, this is how much you could take. Now, generally, a lot of nonprofit consultants will say, you should only take out 5%. Well, to be at 5%, this isn't a charitable remainder trust, this is a charitable growth trust. And I personally don't think that's necessary. I'd rather have more money. So in this case, we use 7.5%. In actual fact, that winds up, whoop, I need to be over here. That actually winds up being 8.58% because of the money we put in, and that's basically return on principal as you go through and do it. So these are very important. Now you may be looking at this and going, you gave all the money to charity. Aren't your children really pissed off? Aren't they going to kill you for what you just did? You're dead. So first of all, they can only get mad at you after you die. And you don't have to tell your children anything about this. We talked to our children beforehand. They agreed this was a great idea. There are other things that they get, so they were fine with go ahead and give the money from this away. And we love the idea of what you're doing with it because they happen to be fairly philanthropic. If it really bothers you that your kids don't get it, you can do this. You could get an insurance policy against it, second to die, that says, going to give away $500,000 up here, but incidentally, I have an insurance trust that's going to pay them $500,000 when we die. So now the charity gets the remainder and your kids get the $500,000. Now you can take the money out of what you're earning, gift it to the kids effectively to pay for the trust. So this gets you away from, my kids will kill me after I die. All right, they can't kill you twice, but this would let your conscience clear you in terms of what you're doing. The other thing is, we've sort of pushed some of these things around in different directions, but in this particular case, I've set it up so that it's a charitable remainder trust at 5% for 2 years plus 10. I'm sorry, 2 lives plus 10. Get $164,000 tax deduction. It's 2 lives. So in this case, if it was Gene and I, it would be Gene and I, and then another beneficiary or beneficiaries get money for 10 years. Charity's going to have to wait a fair period of time. They have no cost or carrying in here. They're making no guarantees or anything else. But that, in fact, defers it off into the future. 5%. It earns 5.59 because of the length of time that it runs. This is actually set up for both lives and 10 plus years for beneficiary. So this way I've set it up and been able to support somebody for the next 10 years. In my example of what order do you do things? Here's an example where do you sell it and give to charity, which incidentally, Pete Kote was the one that originally had recommended that we look into a charitable remainder trust. We were just about to sell the building. And Pete said, yeah, look at this. So we held off. If we had sold the building and done charity, I'd be in the left column. The way it wound up, we're in the right column. So let me show you an example. Arbitrary. The asset's worth $1 million. $100,000 basis. Capital gains $900,000. Personally, I think the all-in capital gains rate is 40%. You're going to have to pay capital gains tax of $360. You net $640. Okay. I'm going to give it all to charity. I give it all to charity, $640. I get another income tax deduction of $224,000. That's what I get. I have an income tax rate of 35%. So I save $78,400. If I give that $640,000 to charity, if I'm 80 years old, 6.5 is my rate for a CGA, I get for the rest of my life, I should get $41,660. If, however, I gave it to charity first and they sold it, then what would happen is they sell it for $1 million. I get a charitable deduction of $350,000, not $224, at a 35% tax rate. That means I would get a $122,000, $500 tax savings, which is $44,000 more than 50% more. If I gave the $1 million, 6.5%, I get $65,000 for the rest of my life, which is $23,340 a year more for the rest of my life. And incidentally, David really thinks you're a wonderful person because you gave him the $1 million, not the 640, which he would have been happy with. But just to be clear, he'd be happier at $1 million. Doesn't get a commission. There's nothing in there, but everybody wins if you give it to charity first and they sell it. And that's very important. And when we've done these before, I think this slide, people come up and go, oh my gosh, what I should have known then or what I do know now, where am I going to go? Because this is critical in terms of what you're going to do and how it's going to help you. So there's my preaching. David.
All right, so now we're going to talk about life estates. You've heard of a reverse mortgage. Well, this is going to sound a lot like that, but it's a charitable life estate is something that we're going to be talking about here. What we call and this would be something where you donate your home, or it could even be it could even be a vacation property that you have. You donate it to charity, but you've retained the right to use that for your lifetime, right? So that's a life estate. You're retaining the right to use it. And so you continue to live in your home. And even though the charity now technically owns that property. You know, they own the property. So there's a lot of really fascinating elements to this, and it's worth knowing about. So we're going to dive into this a little bit. First off, you know, there's immediate value back to this because of the tax savings that you're going to have on that, as opposed to if you left that property to the charity after your lifetime, when it just would pass to the charity and so forth. So and might reduce your income tax. I'm sorry, not your income tax, but your estate tax. This way, you're actually reducing your income tax. So we'll talk about that. But importantly, something to know is that you are committed to maintaining. You're going to maintain the property. You're going to pay the insurance on the property, and you're going to pay the taxes on the property. So those are things that you continue to do, even though you've gifted the property to the charity. But that's part of the exchange of your continuing to live in that property.
And
so,
David,
yeah.
Since we have 8 minutes to go, dun.
Let me jump forward, right? Okay, we got 8 minutes.
Yep.
So
example?
is that you do get the charitable deduction right up front. We're going to go over and use a specific example of this, and that's what we're going to jump to at the moment.
And all of this is in your handout material.
That's true, and you can go back and read that pretty quickly and easily. So in this case, you had a building that you bought, but that you paid $100,000 for. It's grown in value over the time that you've lived in it. It's at 500. It's at a total value now of $400,000. So you had a $400,000 growth in the property. If you decided to deed this to charity through this life estate, it would set up this value of $500,000 that you get a deduction for right now. And as Don and I talked about earlier, you can carry that charitable deduction forward as well. So in this case, because of the calculations, you get a $334,142 deduction, which could save you up to $106,000, almost $107,000 in income tax. If you didn't need that full deduction in that 1 year, it's okay. You can take that for up to an additional 5 years beyond. And then after your lifetime, that property, which has probably continued to grow in value, passes on to charity. And in this case, we've shown it at almost $1.6 million worth of overall value that you passed to the charity. Let's go to the next slide.
Yep.
So what I wanted to show you here is that some charities will do a retained life estate in exchange for gift annuity. So they'll actually allow you to live in your house, and they'll pay you to live in your house. And so that's something you can do as well. And so here's an example for you. Again, you can see the numbers on here. You get the charitable deduction of $177,000. That saves you $56,000, almost $57,000. There's that. And then you're continuing to get a payout to live in your property of $23,691 a year based on that $500,000 value. And then again, after your lifetime, that asset goes on to the charity. Now, you've got to have a pretty major charity that's going to set up a retained life estate in exchange for gift annuity. So a lot of ones don't do that, but some of them do. And so that's good to know about. Let's hit the next slide.
Donor Advised Fund. We talked about it a little bit along the way. In a sense, they're almost like a private foundation, except you don't have the overhead, you don't have the restrictions. You put money into it, again, with either a brokerage house or just a Schwab, or you do a community foundation. Orange County Community Foundation does them, and you put in the money. What you do is donor advised fund. The donor advises the firm, the organization, the community foundation brokerage firm. These are the charities I want to give to. They verify that they're a valid charity. If they are not, they're not going to cut a check for it. So you can't order them to pay it, but you can, in fact, say, this is where I want to go as long as they're valid. And the same thing really happens in a private foundation. It's the IRS that would catch you. Low dollar amount to open them, low fees. It's a good way if you want to bundle your deductions. And incidentally, I forgot something way back up under the CARES Act. During 2020, you can give $300 to a charity, and it's referred to as an above the line deduction in 2020. Even if you don't itemize, you can deduct the $300. There's a discussion of whether that's for a married couple, is that $300 or $600? The best answer we've gotten so far is it's 300 you can give. That's an above the line deduction that be aware of that you should request if you've given money. You
And
cannot
that's
use
a charity, right? Not to your
Sorry?
donor fund.
You have to give it to a charity, like a QCD, for instance. You cannot fund a donor advised from a QCD. They don't allow it today. They may change it later. After you advise it, you manage the account while you're alive, and afterwards you give it to your family or someone else to manage. Again, sort of like a legacy, going through and looking at it. So that's basically where a donor advised fund is, and they're very popular now.
All right, so let's just, as we're wrapping up here, let's bring it all together. That charitable gifts are a way to develop or continue a legacy. If you've ever set up an endowed scholarship at a university, maybe your alma mater, you can add to that through an estate gift, or you can make gifts throughout your lifetime that help support and grow that and really establish a meaningful legacy. And you can do that with all sorts of organizations. I cite higher education because I've worked in higher ed for 27 years. It's important to know that you have a range of options here. We've given you an overview during this presentation. These are all things that you want to explore deeper. You can contact someone like myself as the director of plan giving, or in my case, assistant vice president for legacy planning. But same concept, right? Plan giving. You can contact one of us at a charitable organization, and that charitable organization will put together ideas for you that help you understand how these things work. So then you can go and talk with your advisor, your CPA, and sit down and talk it all through and make sure it works. So it works how it works best for you. So here are the things that you need to do to make it happen, right? You want to do your current and future planning. You need to make sure you're taking care of yourself and your loved ones, and then the charities as well. So I usually think of it in terms of take care of yourself, take care of your loved ones, then take care of charity too, right? If you can go that step beyond as well, or do both, right? So support all of them. Make sure you discuss with your beneficiaries what you're doing. If you're doing something charitable, I think it's important to have those conversations with your kids and other loved ones, with your heirs, so that they understand why you're doing something as well. And it's really a way of continuing your values and explaining what's important to you and why. Always consider what the options are. I think talking with the charity, letting them know what you're doing. If you've got something in your estate plan, they would like to be able to recognize and honor you as a member of their legacy society. It's a great thing. You get a birthday card throughout the year and other connections, and I don't know, they just treat you extra special because they want to take care of you, and they want to say thank you. Because you're really having an impact for others. And with that, I want to put my contact information up here for you. Again, I'm not an attorney, but I really want to provide helpful information that I can. And so that's the resource that I am, is that if there was anything during this presentation you have questions about, I'm glad to help and provide information and specific examples. I know Don will do the same.
Don will do the same. So there's my contact information. It's the beginning of the presentation. It's at the end. As David said, all we can do is help you and give you ideas and thoughts. We're not telling you, as Pete likes to say, we are the seminar that tells you don't sell anything, don't do anything, but think about a lot of things. So that's the way we sort of look at that. And as a point, and at the end of this, here's a form that I did just for my own information for people. If someone said, hey, can you help me? These are the kinds of questions I'm going to ask. There is a copy of this freestanding on the website that is this form. And so you can go through and use that. But you're very welcome to send these to me. Send me an email and let me know you want to talk. We can chat, we can do whatever. I've done it with a bunch of people, and hopefully we've helped people. So I'm going to stop sharing and tell Pete he can come out of hiding. Pete left earlier, saying, I know he's around here somewhere because he's been answering questions. Pete, good God, this is unreal. Oh, there you go. Hi, Pete.
Make sure you unmute yourself, Pete.
There we go.
There you go.
I was busy answering questions.
Yes, you were doing great. I was looking at it going, oh, Pete's having a good time today.
Yeah, and you're so right, Don. It's just you got to run the numbers, and the wonderful thing about the software, it can give you some really good answers very quickly. So before you sell an asset, and there's a large capital gain, look and see whether or not there's a charitable alternative.
Yeah.
And like Don, I mean, he was amiable enough to run the numbers. And that's what we kind of tell you is run the numbers and see what it looks like. There are some people that has such a low basis in their assets that using a charitable remainder trust or a charitable gift annuity provides the best financial solution. And there's a gift involved.
I mean, in our situation, I mean, to be honest with you, in our situation, we sold the building for $6 million. Our basis was 100,000. Oh, heck.
Yeah.
We would have had a huge capital gain, and we got a very large tax deduction currently. And David was nice enough to run the numbers to get us started. And then that's what we've got, the same software, and can run them also. And Pete's absolutely correct. I mean, that would have been horrible.
And
It costs $1 to give $1.
yeah, and Dave said it as well. It's hard to believe, but you know, most of the professionals, CPAs. I gave a lecture to 120 CPAs in the room, and they didn't believe some of the benefits of a charitable remainder trust and a charitable gift annuity because they don't work in that area. They're tax folks who do accountings, and it's after the fact.
Don't pick on CPAs.
Yeah, it's not before the fact. So,
and I'll go one step further. Even, I mean, if you talk to your financial advisor, now not a financial planner, but your stockbroker,
yeah,
they're going to say, well, none of those things work out because incidentally, if you do a charitable gift annuity, charitable gift annuity, the stockbroker doesn't have the money anymore. It went to David.
Yeah.
So,
yeah, and so it's hard to believe, but it's true. You probably know more having listened through this session than most of the professionals out there. And so we can guide you to some professionals to see how it works for you, but nobody knows up front how it may work unless you run the numbers.
Yeah. We'd be happy to. David would be happy to. I know he would. Happy to do any of those things. So I'm going to guess Pete's done a pretty good job of answering questions along the way. Since we're now after 3 o'clock, I will respectfully stop our recording, and we will go through, because we keep a record of all the questions. They come to us and we keep them. And we can then respond back to any of the questions or anything else. But I'm going to stop the recording at this point. As soon as I can figure out my mouse.